Sri Lanka needs to divert from the current tax methodology in order to reach the government estimated tax revenue for the upcoming year. Thoughts echoed by tax experts say that the government must impose tax on capital over labour and income over consumption in order to raise tax revenues going forward to the next year. Today we have Raja Kulendran of Verite Research joining us in our next segment, Understanding Taxes in Sri Lanka, to further explain the government's tax methodology.
Raising revenues for Sri Lanka is of utmost importance because Sri Lanka has one of the lowest revenue to GDP ratios in the world, and also almost 75% or even more of revenue goes for paying interest costs. Given these critical ratios, Sri Lanka needs to increase revenue, and it's of utmost importance. Even the 2024 budget expects revenue to be increased by 45%. The concern, of course, is how are we increasing this revenue, or how are we expecting this revenue to be increased? Even Dr. Shamini Kure, in her recent oration to the Central Bank, stated that Sri Lanka is focusing more on taxing labor over capital and taxing consumption over incomes. And these ratios need to shift. We should be taxing capital over labor, and we should be taxing incomes over consumption. And when these ratios shift, that is how we raise revenue. Verite Research, along with UNICEF, has published how to increase revenue of various revenue proposals in its recent fiscal space study that is available online. And there are various other revenue enhancing measures that Sri Lanka can also opt for.